Moving on to the grain markets now, fertilizer prices, shipping challenges, and the weather in South America continue to impact the markets. To break down the latest information, we were joined on Tuesday by DTN lead analyst Todd Hultmann. I began the discussion by asking Todd if he thought we could continue to see $6 corn.
I think $6 corn is going to be tough to maintain this year. Right now, we're enjoying some South American weather threat. We've had dry conditions in Brazil and Argentina that have helped give corn prices a lift. Late in 2021, we got a real nice boost for corn from the ethanol side of the market. We had some very strong margins at the plants that really helped corn bids throughout the country coming from those ethanol plants, but that ethanol demand has slowed down since. We've seen the ethanol inventory come up higher. So other than the uncertainty of what lies ahead for South America, I don't know what there is a lot in terms of giving us a strong bullish argument to maintain corn at this $6 level. So I'm a little concerned that opportunity may not last too long here early in 2022.
Todd, certainly one of the things a lot of producers have been tracking is the price of fertilizer. As you and your team there at DTN have evaluated that, are you thinking we might see some relief as we near the spring, or you expect prices to remain high for fertilizer?
Boy, I wish I could say there's relief ahead, but to be honest, I think it's going to be very difficult for fertilizers to come down between now and planting time. We're just in kind of a tough situation here as far as fertilizer availability. It was encouraging to me that the natural gas prices come down. After Hurricane Ida last fall, we saw those natural gas prices spike higher, and that was part of the fuel that kind of lit the fuse on the fertilizer situation. Those gas prices have come down, but I think it's still tough, and we still seem to be very vulnerable as far as importing the fertilizer we need for planting time.
Let's talk about the soybean market. Todd, we've seen some strong crush and demand for oil there, leading to some higher prices for soybeans here in the near term. What do you make of that market as we move forward through 2022?
Yeah, Bryce, this is one part of the market where I'm fairly optimistic on long term. And for a long time, it was demand for soybean meal that was really the stronger leg of the two soybean products. But now we've got some new renewable diesel products on the biodiesel side of the market that has given higher value now to the bean oil side of the equation. So at the present time, we're experiencing crush margins that are historically quite high. Typically we see crush products total maybe $1 or $1.50 above the cost of soybeans. Well, recently we've been more like $2.50 and above. So this is very attractive time for the crush margin and for the crush side of demand on soybeans. The one thing holding the soybean market back, though, has been a disappointment with our exports and specifically to China this year. They're down about 28% from a year ago. So as good as that crush demand has been domestically, we've had a lot of that offset by disappointing exports.
As we look back to the last time you appeared on Market Journal, Todd, you gave some of the details about the challenges that folks might be facing as they're trying to haul grain across the ocean. Prices skyrocketed here when it comes to the supply chain disruptions. Have we seen an ease of that over the past month and a half, 2 months since you last appeared on Market Journal?
Bryce, there is steady progress, but I have to say it's very slow. First of all, we need to get people back to work so we can get the country moving again, no matter what the transportation need is, or unsnarling a lot of the log jams at the ports. We need to get people back to work. And we're still about 2.7 million jobs short of where we were before the pandemic hit in 2020. And then as far as the shipping costs go that you asked about, the cost of a Panamax vessel from the U.S. Gulf to northern China is still up about 50% from where it was a year ago. So we've seen improvement. We're down from the peak that was made in October. But it's taking time, and I think it's just not an easy situation to solve, and I think easily another 6 months to try to kind of normalize this process, but it's definitely taking longer than a lot of us would like.
Before I let you go, Todd, final thoughts from you. Any risk management advice you'd like to leave our viewers with today?
Yeah, well, anyone at home, I want you to think long and hard about if you have old crop corn or beans in the bins. These are actually very good prices. And we're enjoying a little benefit now because we've had some weather threat in South America, and nobody can guarantee just how bad that threat will get or how long it'll last. So I think you have to think pretty seriously here about taking some risk off the table in old crop corn and soybeans. For new crop commitments, I'd be very careful, especially in the case of corn. It's going to depend a lot on your fertilizer needs, and it's going to depend a lot on if you have access to irrigation or if you feel like you're in a drought area. That's going to be very tough to make commitments to production. So I'm not as eager to jump out there making commitments on the new crop price just yet, but to old crop, I think it's a good time to take a good hard look.
Good things to remind our viewers of. Todd, appreciate you coming on the program today.
Thank you, Bryce. My pleasure.